Aloha, we're SC Finance Strategies and Insurance Consultants. As finance strategists, we eliminate financial stress from our clients. And in this video, we will be sharing one of our favorite tips, how to save money on income taxes.
Okay, so I was thinking about our clients and other people that we know who are taking their RMDs, minimum required distribution, from their qualified retirement accounts. And I wanted to share this favorite tip to save on their income taxes that become due when they take their distributions.
But this tip doesn't apply only to those taking MRDs. No, this is a favorite tip because anyone who has any income that is taxable can benefit from this tip. So if you are taking MRDs from your retirement accounts or know and care about someone who is, check this out and share it with others. And note how you and anyone else with taxable income can use this tip to save and actually make money on the taxes you pay.
Yeah. Okay, so here it is. If you have a whole life insurance policy, chances are you can do this. If you have a whole life policy that I designed for you, for sure you can do this. I'll get back to the design aspect a little bit later. So here's the tip. When you receive the taxable income, deposit as much of it as you can into your whole life policy. Putting the extra money into your policy will, at the least, increase the cash value of your policy. And that's the part that earns you the guaranteed compounding interest. Then, when the tax on your money comes due, usually in March or April of the following year, take a policy loan to pay the tax. Why? Because the cash value of your whole life policy earns a guaranteed 4% compounding APR. And if your policy is with the right company, even when you take a policy loan, all your cash value continues to earn that compounding interest.
That means that your cash value is growing while the money's in your policy, and it continues growing even after you take a policy loan to pay the tax on it.
Okay, now that's the simplest way to put it. Now, let's take a closer look at what actually happens and the resulting benefit to you. I'm going to use the example of a distribution from a qualified plan. But remember, the income could be from any source. For those who aren't sure what a qualified plan is or what that means, it just means any savings or investing account that lets you defer income tax on the money that you put into the account until you withdraw it or take distributions. So let's say the MRD for your account is $10,000 per year. So you take that $10,000, on which your income tax will be about 25%, or $2,500. Instead of putting it into a bank account, you put it into your whole life policy. And I'll get back to that. Let's say you've had your whole life policy for a while and you already have $20,000 in the cash value. With our favorite provider, the current dividend interest rate is 6.2%. But for 2021, it'll be 6%. So we'll use the 6% figure. Without adding anything to it, your $20,000 cash value is going to earn $1,200 next year. But now, adding another $10,000, your MRD from your qualified plan, into it, it'll grow by $1,800 next year. To pay the income tax on the $10,000 distribution, you need to take about $2,500 from it. But instead of withdrawing or surrendering the $2,500, you leverage your cash value and take a policy loan for the $2,500. Again, with our favorite provider, the policy loan will cost you only 5% annual simple interest. On the $2,500, at 5%, the interest is just $125. The dividend interest you will earn on that same $2,500 is 6% or $150. That means you profit $25 on the $2,500 loan. But that's not actually the way it works, because you see, you'll actually be earning that 6% on the entire $30,000 of cash value, or $1,800. So, using this strategy, you'll have $31,800 in cash value at the end of the year, and your tax on the distribution is paid. Then, that $31,800 will earn another 6% the following year, and you'll have another $1,908 added into it in interest, bringing your cash value up to $33,708.
Now, that's without adding anything else to your policy. But if you had your policy for at least 4 years and you're still paying premiums on it, most, if not all, of your premium payments are going into the cash value at the same time. And of course, that money is earning the 6% compounding dividend interest as well. Now, many who are self-employed or business owners already put money into a bank account regularly to save for their quarterly or annual tax estimates. And I'm sure that you can see how superior the strategy is in using the cash value asset of your whole life policy as your savings for tax payments. Obviously, the interest earned in your whole life cash value is many times that of any bank account. And even after you pay tax, and even if you pay the tax bill, your money continues to earn that high compounding interest.
Now, I mentioned if you can and as much as you can regarding depositing into your whole life policy. And that's because if you have just a straight whole life without any riders, you may be limited to adding a maximum of 10% of your annual premium into your policy. Even if that is the case, that would be a good thing to do, because just about all of that extra 10% will go into your cash value and collect the dividend interest. If you're in reasonably good health, you may be able to add a paid-up addition, or PUA, to your policy and add considerably more than the 10% of your annual premium. And that would be a really good thing, because again, just about all of the PUA money will go into your cash value, and it will increase the total amount of insurance of your policy as well. If you have the riders that I nearly always design policies for our clients with, you will be able to prepay at least one of them in order to get that cash into your cash value. You'll want to stay below the MEC limit when infusing cash into your policy's cash value, because if you exceed that, you will lose the tax-free benefit of the cash growth. And these are all technical issues that we can help you with, and we're here to help. I feel better now that I've shared this tip with you. Now, you go share it with the people you know.
So please post your questions and comments here and subscribe to this channel. Aloha and mahalo for watching.